This is Dale Pinker with TradeGATEHub. I want to welcome you to our special guests, and Eddy Effenbein is with us today. I've interviewed Eddy in the past. He's a market veteran, been around for a long time. And Eddy, you have a reputation, somewhat of a contrarian. Your ideas, and I went through your Twitter stream, like when you saw some of the meme stocks acting, coming back to life this week. You said this isn't normal, and I'm wondering, with this big rally that we've had in the market since mid-June, since the solstice, what a contrarian would do with a market like this if they were flat.
Yeah,
and
I don't
not
really
investment.
I don't have any sort of particular view on the market, but I would remind investors that bear market rallies are very typical. So this is the second 10% plus rally we've had within this bear market, and bear market rallies are designed. Their raison d'etre is to lure people back into the market, people thinking that the coast is clear. So you will always get a couple of bear market rallies. These are head fakes and everything goes right back down again. It doesn't always have to make a new low. So I would just caution people, because a lot of the problems that we had in the market, higher interest rates, inflation, supply chain, all of these issues, what appears to be a slowing economy, they're still there. Those have not gone away. So until that becomes more clear, I would say that the smart way is to be conservative on these bear market rallies and judge them as guilty, and they have to prove their innocence.
Okay, so if people have had a recovery in their portfolios, and I know a lot of people that were very nervous, including my sister, and they've had, that's when I get a call. My portfolio's down. I'm sure it happens to you too. So what would you advise, that they be raising cash on this rally here if you think it's a bear market rally, and reducing their exposure to equities? And if not, what sectors do you believe will hold up the best, should we get at least a pullback in the market?
So the two questions is, will the market go down? I want to be clear. I don't think that's necessarily probable, but it's a distinct possibility, and historically that is what happens with these bear market rallies. The second part, how to position yourself, is a very good question, because right now I would say it pays to be conservative and shy away from the riskier stocks. Let me take a step back.
Okay.
When the COVID broke out, the Federal Reserve lowered interest rates to zero, and we had massive amounts of stimulus. What that effectively does is it takes risk off the table. The government blocked risk. So that's why all of these risky areas just took off. All of these high beta names made astounding profits. And you see, Peloton and Zoom and all of these stocks that made. So beginning last October, November, when it became clear that the Federal Reserve was going to start raising interest rate, that massively changed the calculus behind investing. Now, think of it this way. Who cares about a price earnings ratio when interest rates are zero? The PE is 25, 30. It doesn't matter. It could be 50.
Well, it's a free ride.
Exactly. The risk, it's the return, and the risk is gone, so you just got return left. Now, suddenly, with interest rates going up, it looks like it's going to go up over 3%, maybe 4%. Who knows exactly? Suddenly, the math is important again. And that's what we saw is, the devastating look at, like, Netflix down with like 70% or something, these huge losses. And I think that's going to continue. We're going to see these low volatility names. These are areas like consumer staples, healthcare, I think looks good. Generally higher dividend
Defensive.
stocks.
So defensive
Exactly.
stocks is where people should be focusing still, not on growth. So value over growth still.
Absolutely.
Okay. And, we look at this, last two numbers we had, the inflation numbers this week, came in lower than expected. The market's cheering it. Even after last week, we had that very strong jobs number. People picked it
Mhm.
apart, said they were mainly low quality jobs. So a lot of people are starting to talk about the Fed pulling off the brakes a bit. Do you think they'll push back on that at Jackson Hole? I know they kind of, they're not bashful about pushing back on this. You think they'll be even more strident, even in the face of some better inflation news? Because you and I were around in the 70s, and there were temporary inflation peaks, and it pulled back just like any other market. It doesn't go straight up. And so perhaps we're having inflation compared to what it was tampered down, but
Mhm.
then it reemerges. That's what happened in the 70s. And even Paul Volcker had to go for it twice. And the last time really got very draconian, but it even took a guy like that, called the liquidator, two tightening cycles to get it done.
And
So
the peaks got higher and higher.
yeah,
Going back to the mid '60s, each peak and trough were higher, and it just ratcheted up, and then peaked at about 1980, and
yeah.
then Volcker got very serious about it. So
We
I
couldn't
think
handle a Volcker with the leverage we have in the markets and the economy today, could we? We couldn't handle that kind of move.
I don't think so. I don't think that there's the political will to have that. I mean, it was a very serious move from the Fed in the early 1980s, and actually, ultimately, he lost the rest of the committee outvoted him. That was until like the mid 80s. That's unthinkable to imagine a Fed chairman losing a vote to the rest of the FOMC,
I didn't know
but
that.
that's how dramatic it was. I think the Fed is going to continue raising interest rates. Probably, let me see, in September, I think we'll see another. So there's Jackson Hole at the end of
Yeah.
this month. And then in September, they have a meeting. I think we'll see another 75 basis point move. After that, I think it gets interesting because we'll have meetings in November and December. And I think I wouldn't be surprised if we'll get like 25 basis point increases. And actually, after that, that's the real question, because I would say right now it leans that what traders expect is the um, Fed will sort of pause and take a few months off, and even there's a possibility that the future market expects a Fed
Cuts.
rate cut. That's right.
Yeah.
Then this the probability has wavered a lot, but it's been over 50% expecting a Fed rate cut around the middle of next year. I think that's a good example of just traders sort of hedging their bets. I don't know how realistic that is, but I would say historically there have been Fed pivots in policy like that, but there have not been expected Fed pivots like that. So
Okay.
that's what makes this time period unique.
Yeah. I mean, the only reversal pivot, and I think that a lot of people think they're going to go from tightening to easing, and don't they just have to stand pat before they go back to easing, where they're not easing, but they're not raising rates anymore? Maybe they still do QT, even though they're
Well,
not raising rates.
I think that's a good possibility. I mean, look, that's the problem of stagflation, is that you need to cut rates and you can't cut rates. That's the dilemma of that. Also, we have the issue of the strong dollar, and if you've been reading, anyone who's been reading the earnings reports, that's
They're
always
all
come through.
complaining about the translation, right?
Exactly. And I try to be as an analyst, I try to be a little forgiving about issues regarding currency, because those come and go. But it's been pretty broad, and look, the dollar reached parity against the euro. We saw
Yeah.
some of the largest moves in many years,
20-year
and
high is the dollar, took out a
yeah,
20-year high against the
and
euro.
that's weighing on the Fed. That is absolutely weighing on the Federal Reserve.
Well, do you think the Fed would welcome a weaker dollar And do you think there's a possibility that would actually give them cover to be able to raise rates with the dollar weakening?
Absolutely, absolutely. And one of the Fed's the Fed, they give speeches and they move interest rates. That's basically what they do. And I wouldn't be surprised if we get some jawboning on the currency. Historically, the dollar policy has been more the purview of the Treasury
Treasury.
Department,
Yeah.
but there are always exceptions. But yeah, it makes it easier for them to have a tightening cycle.
With a weaker dollar.
Yeah,
Okay.
and as of now, we really haven't felt the weakness in the labor market. There were some issues with the last report, and also I would point out issues with the last inflation report we got yesterday. Um, but it's until there's real visible damage, I think the Fed will have latitude to implement their policy.
Yeah, especially with S&Ps at 4,200. It's not like
Exactly.
we're at 2,700 or something like that, where it's the market. They say they're data dependent. My friend Peter Bookvar says they're S&P dependent, but they want to
I
break the
think so.
market. They want to break
Mhm.
the market, don't they, Eddie? They want to break real
um
estate. They want to break the market. Isn't that part of their mission is to, have some asset, the negative wealth effect, demand destruction,
I don't think
occur?
they would mind having certain areas of the market broken. The
Okay.
thing about the Federal Reserve is that it's a very blunt instrument, and people expect it to do very high precision surgery, and that's not how
Yeah.
the Federal
Good
Reserve
metaphor.
is. Yeah, it's not designed for that. It's a big club,
Yeah. It's,
and
it's not a scalpel.
yeah, and for example, when the economy was slowing down prior to the financial crisis, it wiped out the entire housing market. I shouldn't blame the Fed for all that. There are other people involved, but that's how it is. People, I think, expect more from the Fed that they can reasonably deliver.
I once asked somebody, do you think the Fed is making a policy error? And he said they always make policy errors.
Yeah, I mean they always do. If you saw, I posted this. I've seen other places, and basically their estimate for they follow the PCE
Yeah.
instead of CPI, and their estimate for PCE for this year. I mean, it was like started out at 2%, and
Yeah.
then I mean, even when inflation became visible, they raised it to 2.1%, and then 2.2, and now it's up to 4.3 or something like that. They're just woefully behind and just did not see what was coming. And I think they believed their own propaganda about the transitory nature of inflation.
Okay. Any view on bonds, Eddie? I mean, we had, the biggest bear market in my view, which is a bigger market than the stock market, was the
Yeah,
bond market. I mean, it was really a crash. Okay. I mean,
yeah, it
it
really
took
was.
out the COVID lows by a lot, but we've had this recent recovery in bonds, and it actually technically looks like I'd buy pullbacks and think that there could be more left in the bond market to the upside, maybe to 132. A lot of people were touting the great steepening on Twitter. Do you remember all those tweets about the great steepening?
Mhm.
And
Right.
instead, we got the grand inversion. Right? So, you have a view on treasuries? Do you think that people, it didn't work to be, for 60 stock, 40 30 bonds, 10 cash, because the part of their portfolio got hammered too? Where do you stand on
Yeah,
long
I
duration
believe that the 60/40 had its sort of worst returns ever.
ever?
I might not be exactly right on that, but nothing. When they are correlated, they move in the same direction like that. That's very very bad, and it was worse than the stock market.
Yeah.
I would say I'm more neutral now. I would say leaning towards bullish on the long end. I think those rates could come down. possible slowing of the economy, possible victory over inflation to some extent. That could last for a while, but it really goes back, goes back to the Fed when we had the 210 went negative. I don't
Yeah.
know. Do you know? Is it still negative, or has it reverted to positive?
No, it's still negative.
And so, classically, that's always a negative outlook for the economy. So I would say I'm leaning towards being a bull on the broad bond market broadly, especially at the long end.
Okay. And when you look at what's happening there in the bonds, when you talk about possible inflation, anything you see in the miners, or what sector commodities, you have any view on the commodity market? Silver recently had a heartbeat,
Mhm.
really had a big up day, this week when the act, the Inflation Reduction Act came in, and and we both laugh at that. And silver is used in solar panels, and it's never
Mhm.
recovered; it's destroyed. So, anything you see in that sector that's been out of favor for a long time in the miners?
I can't really say that's sort of not on my radar. I mean,
Okay,
I follow broadly to see where the commodities are going. Particularly, I like to look at copper. That's usually a good indicator. But I don't have any on my buy list, any what purely commodity plays. So
okay.
I'm sorry, I
Like a
can't.
Freeport, you trade once in a while because of copper.
Yeah,
Freeport McMoran.
I just I don't I look at it, but that's sort of not a strategy I use.
Okay, oil was a star last year.
Mhm.
I thought we were going to break deeper from here, but looks like it wants to rally here. You do anything in the oil shares? They went from being the biggest dog where we had
I
negative.
know.
We were, we were where you had to pay someone to take delivery of oil at the COVID
Mhm.
lows. It went
It
negative.
was
I
actually negative.
I've never seen futures do that before, and then it became the biggest star for the last couple of years.
And it
Your
seems like
take?
the XLE is it's a universe unto itself. It has very little correlation with the rest of the market. It gets huge, and it's also now it's become an extremely small portion of the market. I think it's around 3%,
Yeah,
probably
it used to
less.
be more like 10.
Yeah, in fact, I wouldn't be surprised if it's merged into materials at some point. Call it all like natural resources or something, just because
Okay.
the returns have been so poor. I like to. I don't have any energy stocks. I like to keep. I get frustrated by the XLE because of its big moves each day, but I just don't have a uh,
Yeah.
more
Conviction on
penetrating
it?
insight.
Okay. Uh, do you have a view on crypto?
I am broadly positive on crypto. I think crypto can be undone by some of its most passionate adherents. Sometimes do not do it well. But I have my view is always let a thousand flowers bloom. So I like crypto. I think it tends to be an either or space. Either you love
Yeah.
it or people hate it. I think it's very possible that it serves a role in the future, but it won't be, quite the dominant asset that some people think it will be. I like the idea that there is something outside of government control. Uh, I would say that the question you ask people is, do you like crypto? Oh yeah, I absolutely love crypto. Do you own crypto? Oh yeah, absolutely, I own crypto. Then the third question is, have you ever used crypto for what I would call an everyday purchase?
Yeah.
And then suddenly people say, well, no, not really. And I think
Right.
that says a lot. But I think that how we have the government in the United States and most of the Western world, there needs to be sources of power that lie outside of the government.
Decentralized.
Exactly. And crypto is made an imperfect tool in this regard. And in that sense, I support it. I don't have an absolute view. Will it go up to 40,000 or
Yeah.
70,000? I just don't know.
The price discovery is difficult, but you like the concept of decentralization.
Yeah, I mean, it's had several bear markets of 90% or more.
So the U.S. government is planning on having their own digital currency, which is not going to be decentralization, is it? It's going to be maximum centralization, and in an attempt to probably eliminate cash.
Hmm.
So I think they'll know every transaction that's made by everyone. Do you
Hmm.
believe they're going to go ahead with that project, and we're going to have a digital coin here in the U.S.?
I would say that I think they'd like to do that. I don't know if they can get away with it, but if the government is involved, the safe bet is that it will increase centralization.
Right.
Uh, and the two phenomena we see are the dispersion of capability and the centralization of authority, and these two are working at the same time. So we're seeing the brilliant minds about the market or something. They're not people coming from the central institutions, but it's people coming away from outside the mainstream, be it movie or music or something like that. That's what we increasingly see. It's the establishment of whatever it is less and less trusted and less reliable. But at the same time, the authority is increasingly centralized. It's a very disturbing trend.
Yeah, it really is. I think that's why people are, moving to assets outside the system. And, I've been talking about how the Russell in the last month or so has been outperforming S&Ps. And I mean,
Mhm.
that continues today. For example, IWM's up 1.2%, S&Ps are up 0.8%. And what is your take on what the Russell represents? I know there's small caps, but what reason could there be for the recent outperformance of Russell's? Really, someone has said there are a lot of stocks that don't make money in the Russell. And to me, that's kind of like the tertiary, or not the flight to quality in equities, like you were talking about, the kind of issues you were talking about. Could this be a sign that we're going to have some kind of speculative blow off? There are some people thinking we're going to march to new highs in the market.
Mhm.
Is the Russell saying that to you? And what's it mean
Um,
to you?
I would say that unfortunately, I don't think the Russell 2000 is a very good index. In the sense, I don't mean the stocks are bad, but it really doesn't give you an eye into any important aspect in the market, perhaps a risk tolerance. But it's not like, make an index of all the oil companies or all the medical device companies. It's a hodgepodge of just companies that are not the largest companies. By the way, when we say small cap, if you're in the Russell 2000, you're a very, very large enterprise. You're just not quite as large. Also, as another important note, I don't think people realize how oligarchic Wall Street is, meaning the 10 largest companies are really, really big. I believe the S&P 500 is about 70% of the market, and the S&P 100 is 70% of the S&P 500. So we're talking those
Highly concentrated.
exactly. And I mean, you could make an index or a portfolio of companies that are almost invisible on Wall Street. There's so much smaller than So there are thousands and thousands of companies that add them all together, they're really not much. So the Russell, I think it tends to lean towards domestic manufacturing companies. That's what and so it could be an impact of the dollar helping the U.S. dollar, because the
Yeah.
basically larger company by definition are more international. I'm being a little speculative here. I don't know exactly why. Um, and I come back to the previous point. I think there's just a risk tolerance that the Russell tends to be stocks that have a higher beta.
Okay.
But that's sort of not it's just an odd portfolio. So I would say the strongest, it's domestically oriented manufacturing companies, has a stronger cyclical bent to it. But that's I think there just are a lot of problems with the Russell 2000 as an index.
Okay. Well, anyone listening to you, Eddie, could tell that, you're definitely a seasoned veteran, and you definitely have a lot of experience, and people may want to continue to follow you. I see you have this CWS market review. You want to tell us a little bit about that?
Yeah, I'm on Substack, so I have the CWS. I do two letters a week. I have a paid one, and then I have a free one. The free one goes out on Tuesday. The paid one goes out on Friday morning. So I give you, my thoughts on the market and what I like at the moment. And I also have my ETF, which so there's a buy list I have, and I partnered with Advisor Shares ETF company to take my buy list and to make an ETF out of it.
Oh,
So it
cool.
is traded on the NYSE. Its the ticker symbol is CWS for Crossing
Oh,
Wall Street. So that's it's gonna have its 6th birthday coming up
oh,
in a few weeks. So
all right.
many ETFs have closed, but we're still going strong. So basically, between the newsletter and the ETF, that keeps me pretty busy. But I like to help investors and give my thoughts on what's going on.
Well, you've helped people that are listening to us live, and will watch a recording later. And look at this, Eddie, you've got a new subscriber.
Oh, excellent.
There you
Welcome
go.
aboard.
And Eddie, really was a pleasure. I want to thank you for giving your time to our community today. And you're my trading warrior brother. And let's not make it 3-4 years before we get together and talk
Absolutely.
again. The deal?
Deal.
All right, everyone. So you're looking, and you've heard Eddie Effenbein, and you could go to his Twitter handle. It's the same as his name, and sign up for his letter and keep in touch with Eddie's thoughts. I think it will be very good intelligence gathering for you. Thank you, Eddie.
Thank you.
All right, that's a wrap, everyone. Have a great weekend. I'll see you next week. Remember, don't just count your P&Ls, count your blessings. And I'll see you. And I love that line, let 1,000 flowers grow, bloom, grow. Real nice line, Eddie. Talk to you later.
Talk to you later.